Today we'll know more about financial reforms including financial inclusion. So in the first part we'll discuss about financial reforms. To begin with, we'll know more about the approach. So the initiation of financial reforms in the country during the early 1990s was to a large extent conditioned by the analysis and recommendations of various committees or working groups set up to address specific issues. Reforms measures introduced across sectors as well as within each sector were planned in such a way so as to reinforce each other. There was a need to have reform in each and every sector. For that, various committees and groups were set up, and on the basis of their recommendation, it was realized that we need reforms and we need to take measures towards it. Attempts were made to simultaneously strengthen the institutional framework while enhancing the scope for commercial decision making and market forces in an increasingly competitive framework. The major aim of the reforms in the early phase of reform, known as first generation of reform, was to create an efficient, productive, profitable financial service industry operating within the environment of operating flexibility and financial autonomy. The focus of the second phase of financial sector reform starting from the second half of the 1990s has been strengthening of financial system and introduction of structural improvements. So the first part consisted of services providing them efficiently, and the second part was related to strengthening the infrastructure as well as the financial system and having the structural improvements in it. As pointed out by Governor Reddy in 2002, the approach towards financial sector reforms in India is based on Panch Sutra or five principles, that is cautious and appropriate sequencing reform measures, introducing of reforms that are mutually reinforcing, introduction of complementary reforms across sectors, most importantly monetary, fiscal and external sector, development of financial institutions and financial markets. So these were the five principles on the basis of which financial sector reforms have been evolved. Objectives of financial reforms very first work was to promote the maintenance of financial stability even in the face of domestic and external shocks. So once you are hit by the financial loss or you have any sort of deficit or imbalance in the financial sector, you should not be badly hit by it. You can have the balance. Such reforms were included now. Financial reforms which can help us to remove the financial repression which existed earlier were formed, create an efficient and productive and profitable financial sector industry was the main aim, enable price discovery, particularly by the market determination of interest rates that then helps in efficient allocation of resources, provides operational and functional autonomy to institutions, open the external sector in a calibrated fashion, and preparing the financial system for increasing international competition. All these three were the main objectives on the basis of which financial reforms were introduced, because functioning of the institutions, even opening it to the external sector and having the international competition were the three major objectives because of which an economy changes from developing to developed. Financial sector reforms consisted of reforms in government securities, market institutional measures, reforms in banking sector, monetary policy framework, reforms in the foreign exchange, market exchange rate regime, and financial inclusion. We'll discuss one by one. First, we have reforms in the banking sector, which consisted of prudential measures, institution and legal measures where lok adalats were set up, and many such measures were set up so that even the common man can avail the facility. Competition enhancing measures, supervisory measures to supervise and regulate the banking services and institutions, measures enhancing role of market forces, technology related measures. Technology related measures were such which enabled using of technology in the banking sector. So I hope you understood all these six of the reforms. All these are discussed in detail in the banking sector reform part. Reforms in the government securities market and institutional measures. Administered interest rates on government securities were replaced by an auction system for price discovery. Automatic monetization of fiscal deficit through the issue of ad hoc treasury bill was phased out. Primary dealers were introduced as market makers in the government securities market. For ensuring transparency in the trading of government securities, delivery versus payment settlement system was introduced. Increase in instruments in the government securities market like treasury bill was introduced so that you can manage liquidity and benchmarking. Zero coupon bonds, floating rate bonds, capital indexed bonds were issued. You can have the exchange trading facility. Even futures were introduced at that time. Very much important that treasury bill was introduced during the financial reforms. OTC interest rate derivatives like IRS and FRAs were also introduced. Enabling measures for foreign institutional investors were allowed to invest in government securities subject to certain limits. Introduction of trading of government securities on stock exchanges for promoting retailing in such securities, permitting non-banks to participate in repo market. So after it, there was an introduction of government securities on stock exchanges. It helped to promote retailing in securities and permitting those institutions which are not governed by the Banking and Regulation Act, they can also participate in the repo market. Next in line we have is reforms in the foreign exchange market exchange rate regime. Evolution exchange rate regime from a single currency fixed exchange rate system to fixing the value of a rupee against a basket of currencies, that is to decide the value of a rupee against the basket of currencies at global level, and further to market determined floating exchange rate regime was there. Adoption of convertibility of rupee for current account transactions with acceptance of Article 8 of the Articles of Agreement of the IMF, de facto full capital account convertibility for non-residents, and calibrated liberalization of transactions undertaken for capital account purposes in the case of residents. Institutional framework, that is replacement of FERA with FEMA, a Foreign Exchange Regulation Act was replaced by the Foreign Exchange Management Act in 1999. Delegation of considerable powers by RBI to authorize dealers, that is AD, to release foreign exchange for a variety of purposes, increase in instruments in the foreign exchange market, development of rupee foreign currency swap market, introduction of additional hedging instruments such as foreign currency rupee options, authorized dealers permitted to use innovative products like cross-currency options, interest rate, currency swaps, caps or collars, and forward rate agreements in the international forex market. So complete revolution was there in the foreign exchange market. All those securities, all those facilities and methods of transactions were introduced after financial reforms. Liberalization measures consisted of authorized dealers which were permitted to initiate trading positions, borrow and invest in overseas market, subject to certain specifications and ratification by respective banks boards. FIIs and NRIs, that is financial institutional investors, and non-resident Indians were permitted to trade in exchange-traded derivative contracts subject to certain conditions. Banks were also permitted to fix interest rates on non-resident deposits subject to certain specifications, use derivative products for asset liability management. Now the banks were allowed to use derivative products so that they can manage their asset liability. Banks were also permitted to fix overnight open position limits and gap limits in the foreign exchange market subject to ratification by RBI. Foreign exchange earners were permitted to maintain foreign currency accounts. All these were happened after having the financial reforms in the foreign exchange sector. Permission was given even to various participants to enter in the foreign exchange market, including exporters, Indians investing abroad, FIIs, to avail forward cover and enter into swap transactions without any limit, subject to genuine underlying exposure. Next in line we have is reforms in the monetary policy framework. Move from direct instruments such as administered interest rates, reserve requirements, selective credit control to indirect instruments such as open market operations, purchase and repurchase of government securities for the conduct of monetary policy. Then there was use of open market operations to deal with overall market liquidity situations, especially those emanating from capital flows. Introduction of LAF, that is liquidity adjustment facility, was there, which operates through different rates, interest rates, that is repo rate and reverse repo rate, to set up a corridor for short-term interest rate. LAF has emerged as a tool for both liquidity management as well as signaling device for interest rates in the overnight market. Introduction of MSS, that is Market Stabilization Scheme, as an additional instrument to deal with capital inflows without affecting short-term liquidity management role of LAF. Development of pure interbank call money market, non-bank participants to participate in other money market instruments. There was an introduction of automated screen-based trading in government securities through NDS, that is negotiated dealing system. There was setting up of risk-free payments and system in government securities through CCIL, that is Clearing Corporation of India Limited. Phased introduction of RTGS, that is real-time gross settlement system. So all this were included in the financial reforms. Quite easy. Each and every reform has enabled the evolution of different services and improvements in the financial sector. I hope you understood them. I have discussed everything in one by one point. So here is the time to check the knowledge. Foreign Exchange Regulation Act 1973 was replaced by Market Friendly Dash Act. Introduction of the Dash, which operates through repo and reverse repo rate auctions to set up a corridor for short-term interest rate. Both the questions are quite easy. If you have understood the video, do answer them in the comment section and stay tuned for more such videos.